Does Trump's tariff war have you looking anxiously at the U.S. stocks you hold? Then you may want to take a bite out of what's been called the only free lunch in investing, and that's diversification. So let's explore if now is the time to pivot to international stocks and what can be a cheaper and easier way to help you do it that you might not know about. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And uncertainty is the theme in financial markets right now. In that light, we're going to explore an interesting investment product that can help make diversification a little bit easier and a little bit cheaper for Canadians. They're called Canadian Depositary Receipts, or CDRs for short. Yeah, it's a mouthful. We're going to dig into the details of how they work and what they can bring to our portfolio with someone who knows them quite well. Joining us is Bipan Rai, Head of ETF and Alternative Strategy at BMO Global Asset Management. BMO offers a growing lineup of CDRs for major international companies from around the world. Bipan, wonderful to have you on the show. Thanks for coming back.
Thank you for having me, Rob.
I think it's a really interesting time that we're talking right now because we had seen earlier in the year all of that volatility around the tariff announcements. Yep. And I think it was a really big shock to a lot of investors, Canadians in particular, because a lot of people had really heavy U.S. stock exposure. Since it's just been a rip-roaring market for so long, yep, that kind of forced people to maybe rethink things. Mm-hmm. Yeah, we've sort of trended back towards all-time highs, but still that uncertainty remains. In your opinion, do you think this is the moment maybe to, again, start reconsidering that heavy U.S. stock exposure if you have it?
Yeah, in our conversations with clients, what we've noticed, especially this year, is that there's been sort of this renewed focus to diversify away from the United States insofar as international exposure is concerned. And again, that makes sense considering where we were at the end of last year, where we did have a heavy degree of concentration, or we saw a heavy degree of concentration in terms of allocation towards the United States. And again, that made a lot of sense, right? I mean, a lot of investors were playing up the AI CapEx cycle and the fact that we had seen, this, let's call it boom when it comes to spending on artificial intelligence on select firms in the United States. And you also had that reflected in stronger economic data at the U.S. as well. And, embedded within that was also implicit trust in key U.S. institutions. And I'm going to lump in free trade and low barriers to capital as well. But that's changed significantly over the past several months. And, over the long term, if I put my macroeconomist hat on, if we're talking about barriers to free trade rising, implicitly over the long term, that also means that if we look at company earnings, maybe the ceiling isn't quite as high as it was before. So it does behoove investors outside the United States, especially here in Canada, to maybe look at other countries where, allocation has been low over the past several years.
I think, when we were talking off camera, you expressed to me that you're not a fan of the S&P 500 and chill type kind of approach where you just hold like an S&P 500 index ETF and you kind of just look through everything. Right. Why is that? Just go into a little bit more depth on that.
Sure. I mean, think about where we've come from over the past several decades, right? There's been this sort of renewed trust when it comes to internationalization and free trade and really a heavy degree of, say, markets moving, but not really dependent on political alignment. We're moving away from that paradigm, right? We're moving into a more balkanized trade backdrop. And that's not going to change, at least in our view, with who's in office in the United States. If President Trump's term comes to an end in a couple of years, we still do think that trade barriers will remain quite significant. And so investing in that backdrop is very, very different from where we've come from over the past several years. So, that's something that I think a lot of our viewers should be, at least pay tribute to as we go forward.
So you sort of alluded to your view there a little bit. Can you maybe go in a little bit of depth? Give us a glimpse inside BMO's crystal ball here. Like, how do you see global stocks evolving over the next year ahead? Again, with that volatility, that uncertainty backdrop there with all the trade stuff going on.
Yeah, so right away I could tell you that if we are moving into this environment, one thing we should get used to is a higher floor for volatility going forward. And that's not just a foreign exchange risk, that's a risk across all asset classes. And so one of the things that we're encouraging our clients to really, really pay attention to is emphasizing the diversification approach, right? So the S&P 500 and chill won't be as effective as it has been over the last couple of years, right? It just felt like we were in the perfect storm for a strategy like that to work. Where we're going forward, to us, volatility levels are remaining a little bit elevated. Diversification diversification is going to be extremely important in order to make sure that portfolio volatility doesn't really get out of hand, right? So when it comes to international stocks, again, one thing that has changed that is quite meaningful from where we've been in years past is that you're seeing a lot of foreign governments looking towards spending, towards stimulating their economies. Now, whether that's spending more on infrastructure or spending more on defense, that means that the fiscal multiplier is going to be important for economic output. And guess what? That's also going to be beneficial for companies in those countries as well. So again, that's quite different from where we've been in the past. And if we sort of dovetail that, or it does dovetail nicely with our diversification approach that we're looking at.
Mm-hmm. Now, speaking of diversification, I know a lot of investors struggle with, okay, I understand that international diversification is important, but how much is enough? Right? Do you have any sort of view on that? Maybe like a rough rule of thumb or anything like that?
Well, it really is a personal question that each investor should really assess on their own, right? I mean, it depends on your risk tolerance, depends on what the goals of your portfolio is. But on a go-forward basis, if we use our own balanced portfolio or a model balanced portfolio as an example, I mean, right now in that we've got 40% invested in the United States, 30% in Canada, and the balance is in international stocks and also international assets like gold, right? So that's something that we've kind of paid a little bit more tribute to, or at least followed more closely since the start of this year. And I suspect that, if it comes to a footprint in the international space, we'll probably stay in that 20% range, maybe sometimes going a bit above that when the circumstances warrant.
Right, okay. Well, appreciate you sharing that, giving a little bit of a depth to our audience there to understand that question. And of course, CDRs are one of the ways that you can diversify internationally if you're so inclined. Right. And so that's what we're going to learn all about in this episode here. And if you have questions about CDRs, as I'm sure many of you do, we want to hear them, okay? So let us know. If you're watching on Webbroker, you can use the questions box there to submit your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on YouTube, you can hop over to the link in the description there, and it will take you over to the broadcast platform, and that's where you'll be able to answer or ask your questions, rather. So let's get down to the conversation here, Bipan, and just kind of give us the lay of the land on CDRs here. Like, how do they work in a nutshell, and what do they bring to an investor's portfolio?
So the first thing I'd like to point out, I should say, is that it gives investors the ability to access foreign shares, right? Not a lot of brokers have that accessibility to foreign markets, right? And so oftentimes, what this means is that investors miss out on tremendous opportunities that exist outside of North America, right? So CDRs are basically foreign shares that trade in Canadian dollars on Canadian exchanges, right? And the important difference between a CDR and an ADR is that a CDR significantly mitigates your foreign exchange risk. The ADR does not do that, right? So again, mitigation of foreign exchange risks, also accessibility to foreign shares of foreign companies outside of Canada. I mean, these we think are powerful enhancers for any portfolio. And not only that, I mean, the accessibility and the ability to invest outside of Canada comes with what you would expect typically. So voting rights as well as participation in dividend outlays as well for investors here in Canada.
So I think a lot of people might, get their international exposure perhaps through something like an international equity ETF or something like that. What would be, the benefit of going the CDR approach rather than just, again, buying like an international equity ETF?
Right. So if you're bulled up on a particular company that exists outside of North America and you don't want the other noise that comes in owning an international equity ETF that may have that company, then CDRs is potentially one spot that you want to look, right? So that's the one beneficial aspect to it. And often, there are ETFs out there. A lot of them are foreign currency hedged, but sometimes they're not foreign currency hedged as well, right? So again, the CDR gives you that benefit of accessibility, while at the same time, mitigates substantially your foreign exchange risk.
I want to pick on that foreign exchange aspect in just a moment here, but maybe just give us a sense of some of the international companies that you can even get exposure to. Like, what kind of companies are we talking about here?
Sure. I mean, if we look at the table that I believe is on screen right now, the first name that pops up is the Dutch company SML Holdings. I mean, that's one that, again, we've launched recently, as well as that, we look at, we have access to markets in Swiss markets, I should say. So you have a couple of large names there, including Nestle and UBS. And of course, if we look at other markets outside of Europe, in Japan, we've got a couple of big names there, including Nintendo, SoftBank, and Honda. And of course, this is an evolving lineup. We're continually looking to potentially issue CDRs based in other markets as well. I forgot to mention also, we've got access to Novo Nordisk, which is headquartered in Denmark. And of course, we've also got Deutsche Telekom in Germany, as well as Mercedes-Benz and Volkswagen. So a couple of big names there potentially outside of North America that a lot of our viewers might be familiar with.
Yeah, and so at this point we're talking about, I mean, of course the lineup is expanding all the time, but we're talking about like your heavy hitter, really uber blue chip type kind of international companies is really what's out there right now.
Exactly, yes.
Okay. Let's go back to that currency aspect for a little bit here. Can you just explain to me like I'm 12 type kind of example of how the currency hedging works with CDRs? How does it remove some of that currency risk?
Right. So effectively, I mean, when we look at, say, a CDR, right, what we should consider is that, yes, you have the foreign share, but there's also a separate element of it that takes care of the foreign exchange aspect of it as well. So effectively, what we will do is we will sell the foreign currency and buy the Canadian dollar on a forward basis. And so what that feeds into is what we call the CDR ratio, right? So the way to think about a CDR ratio is typically how much foreign shares does one CDR represent, right? So if the ratio is 0.5, that means that one foreign share is represented by two CDRs. Right, and so when the foreign, or at least when the exchange rate moves, it does matter for the ratio, and it does matter for how we adjust. So let's take an example. Let's say the Canadian dollar appreciates. That means the purchasing power of one CDR has increased. And so effectively what we do in that case is that we will take the profit that we make off of the foreign exchange leg, and then what we'll do is we'll buy back the foreign share to adjust the ratio accordingly. Right, so it's just the underlying foreign share that should determine the movement of the CDR, not the foreign exchange aspect of it. Conversely, if the, say, Canadian dollar depreciates, so the CDR is worth, let's say, less as a percentage of foreign shares, what we'll do in that case is for the underlying transaction, we will sell the foreign share to offset that foreign exchange loss that we see. Now, typically, this will not show up in the investor's screen, right? Because again, what matters for the investor is movement of the underlying share as it trades on whatever exchange that it's trading on. The foreign exchange aspect of it, we're taking out based on the mechanism that I just described to you.
Okay, so that was a pretty good breakdown of what I imagine is a very complicated back-end process here. But maybe to kind of bring it home for your everyday investor, like how relatable would you say that CDR ratio is to something like partial or fractional shares that are out there in the market? Like, are these sort of like a like-for-like type kind of thing in some ways?
In some ways, yes. I mean, remember the other aspect of accessibility is the fact that, again, CDRs represent they make things accessible by being fractional of the underlying share, right? So again, that makes, say, a certain share of a certain company is trading at X, it's, the CDR will be, on a notional basis, be much less of that, right? So again, it makes, buying CDRs a lot more easier for the Canadian investor instead of going out and, participating in the foreign market.
Yeah. And like, I mean, we'll get more into like tax stuff in a bit here because that's always top of mind for investors here. But like, are there certain investing accounts that you think make sense, generally speaking, to hold a CDR in?
I mean, they're fairly similar to, say, an ETF or a fund in general, right? So they could be, you could buy them for your RSP, your RIF, your TFSA, or any other non-registered account as well. I mean, the tax treatment for CDRs are fairly similar in all cases to what you typically see for an ETF or for a mutual fund.
Okay, that's good to know. We'll get more into that in just a moment here, but appreciate you giving us kind of like the lay of the land of CDRs. And on that note, I want to bring in our senior client education instructor, Bipan Rai, here, because he's going to show us how we can actually research CDRs in WebBroker and actually make a trade for one if we're so inclined. So Bipan, welcome to the show. Great to have you on board.
Always great to be here, Rob. Thanks so much. And, in our department in the education, like the concepts you guys are talking about are amazing. And then what we like to do is we like to kind of bring it to that practical aspect, right? Where we can actually show you on WebBroker, how would I trade one of these CDRs? So how would I look it up and research it and actually place that trade? So I want to jump over to the WebBroker platform and just show a quick idea. I've got an example of one of the ones that Bipan was talking about. We have Nova Nordisk. So if you're ever looking for any of these, you can typically even just search through the enter symbol. So start typing the name. There is a way you can actually look up the symbols as well. But typically, if you ever type in the underlying, you may see a number of different ones. Like here's the example of one that's similar that's on the US exchange. But if you just start typing the name, you will usually find these and it'll show you a Canadian flag showing that it's a CDR. So once we have that up, you can see there's the price. That's $5.91. And this is, remember, this is a fraction of the actual shares on the main exchange that it trades on internationally. I think this one is Danish. I believe it's a Danish company. And you can look at the chart. You can look at an overview. There's a number of tabs here that have a ton of information. You can look at reports to some extent. These are pretty new. So at the same time, some of the information may not be there, but you can see the chart. You can see how long it's been trading for a while. Like if you look at, if I went to 5 years as an example, we might not see the full chart, like it's only going back to about just early 2025. But either way, you can get that information, and then you can go from there, Rob, where there are some external things that you can look at, because the question that comes up all the time is how do I get a listing of all the stocks? If I wanted to know all of the CDRs that are internationally based that BMO offers, and there are other CDRs that you can use that are US based as well, that if you want to look for US stocks that may be really expensive, like Home Depot or Amazon and things like that, that have a fairly high share price, but you maybe want to get you don't have enough money to buy that big of a share. You can also have that currency hedging as well, and basically take advantage of that. But just to show you this, I do have a tab up here. I have a tab that shows the international. So if we jump over to the screen share, the international listing of the CDRs that BMO has right now. And if I scroll down, you can see a lot of familiar companies that are internationally based, like ABB and Adidas. And you guys mentioned like Novo Nordisk. If we kind of go down, Novo Nordisk is here. Novartis, Nintendo. So any like video game people that are excited might be excited about that. But what this is showing the listing. It shows the CDR ticker. It shows the ratio. So if you're thinking this is a little over, 1/10 for ABB, I think Novo Nordisk was something similar. It was around 1/7 of a share. If we go down here, so you can see there's 1/7 right where I'm circling there. And then it also shows you the exchange rate and the currency and the country. So it's really interesting information you can look at. And then there is another one all you have to do is do an online search, just do a CDR directory or listing. And this is one for the US as well that is very similar. So you see companies like Apple and Amazon and so on that most people will be very familiar with, or Alphabet. So all those have the same type of information. It'll show a share price and just that conversion. So if we jump back into WebBroker, one way you can check too, like if I go with Apple as an example, for looking at US CDRs, you can see there's the $33.56. So you can even, if you want, you can do the math in your head. So if I type in Apple here and I go to the US, or you can actually even click on view on the NASDAQ is a really easy way to do it. There you go. Then you can see the price in US dollars as well. So it's showing me 233. So if you go back to the other Apple, which is a fraction of that, you can kind of figure out the ratio in your head. But otherwise, I think finding those other links is an easier way to do it too.
Yeah, it is just a quick Google search away, so that's good to know there, Brian. Okay, so thanks for kind of spelling that all out for us. Let's say an investor sees a CDR, they're thinking about buying it. Is there anything about the purchase process that is different for them, or anything that they would need to keep in mind about that?
No, that's a really good question as well, Rob. I was wondering that too when I first bought a few for myself. I bought them in my kids' RESPs because I wasn't doing really large amounts of stock, just little ones to get some exposure to other areas, the U.S. and internationally. And if we jump back into the screen there, I can show you right now. If we go back to, let's go to Nova again, Nova Nordisk. If we're here, $5.91. It works the same way as a stock. You can just click on the buy button. They make it that easy. We're just going to click on buy. It's going to pull up the order ticket. And then you're going to have that ability to just either enter a market order, where that's going to just go at the next available price, or you can set a limit and just put in your quantity and or a dollar amount too, because you can actually do the potentially just the partial share as well. And see how it says enter the share quantity or dollar amount. So it's exactly the same as buying any stock. Just put in your order, preview it, press enter, and you should have the shares.
Awesome. Great to know, Brian. Appreciate you showing us the lay of the land on WebBroker there. And hang tight. You're going to be back with us a little bit later for a little bit of friendly competition with Bipan. So everybody stay tuned for that as well, okay? But that was TD Direct Investing Senior Client Education Instructor, Brian Rogers. Okay, Bipan, I want to return to CDRs and getting to know them a little bit better. Talk to me a little bit about the liquidity of CDRs. Is it the exact same as the underlying stock would be? Is it a little bit different in some way? Give us a sense.
So much like an ETF, a significant driver of the liquidity for the CDR will be the underlying, right? So, I mean, one of the interesting aspects of it is that trading volume of the CDR does not really determine the bid-ask, how wide the bid-ask is for each CDR. Right, it's really what we're talking about with respect to the underlying. So what we notice is that to get the best liquidity, usually it makes sense to transact in the CDR during that overlap for when the foreign market is relative to Canada. Right, so if we're talking about a Japanese company, let's say, or Japanese CDRs, generally the liquidity, tends to be a little bit more choppier, given the fact that there isn't much of an overlap, if at all, between Tokyo trading hours and the TSX, or sorry, the Toronto market. So what we recommend in that case is to leave limit orders, just to help with the execution process.
And like generally speaking, I know there's so many different ones, but like, is the bid-ask spread on these things, just because they're large companies, typically like pretty narrow, or can they be a little bit wide, and that's something for people to keep in their mind when they're making a trade?
Generally, again, it'll depend on the liquidity of the underlying. But given the fact that since these are blue chip companies, generally the liquidity should be ample enough that the bid-ask spread is reasonable.
Okay. And what about like fees for this product? Like, is there anything that people need to keep in mind? Is there like a management fee or anything like that, or some kind of like currency conversion fee, anything like that they need to keep in mind?
So BMO Asset Management, as your issuer of CDRs, does not take a management fee. Really, how we make our money is through the notional currency hedge, managing that. And again, that notional currency spread will never be more than 60 basis points on an annualized basis for any transaction.
Okay. Yeah. What about, let's go back to tax here. We talked a little bit about the investing accounts that can make sense for these things, but in general, what are some of the ways that CDR might be taxed that you want to keep top of mind?
Yeah, so I mean, the most important is, of course, the treatment of dividends, right? So capital gains will factor in the same as an ETF or fund or an underlying stock holding. If we're talking about dividend treatment, I mean, the withholding tax will apply in the same way that it does for ETFs and the like, right? So, and it also is very much dependent on whether or not there is a tax treaty between Canada and that country as well. If withholding tax is applied, then it's really incumbent on investors to file that paperwork to make sure that they can get that tax rate at the treaty reduced rate. But again, that is going to be contingent on whether or not there's a treaty between Canada and that country.
Yeah, that could be a bit of a headache filing that paperwork, right?
Absolutely, yeah. But a painful but necessary part of the diversification process, we like to.
Sure, yeah. I mean, if you can save a little bit of money doing it, why not, right?
Why not, right?
Okay, so that's good to know. I think it's really nice too that these CDRs are, generally speaking, you can just think of them almost as a like for like on a tax basis as the underlying stock. Like, that kind of makes it easier for people to figure out, right?
Absolutely, it does. And that's part of the process as to why this is such an effective tool as part of the investing process for us, right? So really, the Canadian investor that is, say, bulled up on a company like Mercedes-Benz or even Nintendo, the Switch 2 is coming out, and I know that's going to be a popular item around the end of this year for holidays. This is really a way for Canadian investors to participate in that, because then often in times in the past, and speaking from my own experience, that could be quite a tricky process. If I just want that exposure to Nintendo, I would have to find a different way to find, maybe go through the ADR. But again, that left me exposed to foreign exchange risk. And one of the key elements of foreign exchange risk is the fact that the longer that you hold it on for, you don't get rewarded for it, right? So this is a way for us to say that you own the company without the affiliated currency risk. And I think that's quite a powerful message.
Why is that? Can you just expand on that thought? Like, because I've heard other people say, like, the currency impacts kind of washes out if it's over the really long term. You're saying it's a little bit more nuanced than that. Can you unpack that thought?
So I'm going to tap back into my past as a foreign exchange strategist at another shop over a long time. But remember that the relationship between the currency market and the equity market that we're talking about can vary depending on which currency market we're dealing with, right? So for a long time, everyone would say that if you're a Canadian investor and you invested in the S&P 500, it really made sense to hold that exposure unhedged, because at the end of the day, the S&P 500 oftentimes would move in a different direction than, say, the US dollar, especially during times of volatility, right? The US dollar is that safe haven currency, so it should rally and it should mitigate any volatility in the underlying. But, two things I'll say to that. One is the fact that that correlation doesn't hold on a consistent basis. And certainly if we look back to earlier this year, we did have the example of the S&P 500 falling at the same time that the US dollar did relative to the Canadian dollar, right? So that diversification benefit of having unhedged exposure wasn't quite there, right? And the second thing I'll say to that is, again, the relationship of the euro to the domestic equity market is not at all similar to what we've seen in the US with the US dollar and the S&P 500. Oftentimes what we've seen is that the euro will be positively correlated to underlying equities there. Ditto for the Japanese yen at times with Japanese equities. Certainly you can make the same case with the Japanese yen at times as well. But in periods where there is a idiosyncratic shock, you can't rely on that correlation. right? So you don't get that benefit, I should say, of the currency being that macro shock absorber in places like the United States and Japan.
Okay, so in that respect, then the U.S. is really its own beast that you need to kind of like compartmentalize a little bit.
At times. And again, if we are moving into this more balkanized trade regime, you can't count on that same relationship holding. Right. So again, that makes for a very powerful argument in favor of looking at an instrument like a CDR if you're looking at international exposures.
Now, I want to pick up on that thought because obviously the reason why we're talking today is all the trade uncertainty that's going on. If there was some kind of development in that trade war, meaningfully one way or the other, like how would that influence the pricing of CDRs? I know that's kind of a tough question because there's so many different ones, but are there some developments in that tariff war that would lead things one way or the other in your view?
Certainly. I mean, if we're talking about macro risks, implicitly we're making the foreign exchange argument, or at least talking about foreign exchange implicitly as well. And remember what I said, if you're looking at CDRs, inherently you're making an FX decision. Unlike the ADR, you're still exposed to FX risks. But, within CDRs, let's say, look at the example we're in right now. The Canadian economy has not tipped into a recession, despite what many forecasters would have thought at the beginning of this year. Why is that? Well, it's because the tariffs that have been applied have been applied to certain sectors, including steel and aluminum, and of course the auto sector. But outside of that, if the goods are compliant with the USMCA agreement, then they're not tariffed. Right? That's something that we didn't expect at the beginning of this year. And that's something that it has sheltered the Canadian economy to a meaningful degree. And what that means is, maybe the Bank of Canada doesn't need to cut as much as we had forecasted them to at the beginning of this year. And if they don't need to, maybe the Canadian dollar doesn't weaken as we thought it would. Right? Maybe we're in a scenario where the Canadian dollar will either be stable or there's some upside risk. Right? So that is an example, of a situation from a macro level that if we were unhedged, we would be penalized for, because the Canadian dollar appreciating against a foreign currency means that our holdings in that foreign currency, unhedged, will lose value. Right? But, again, can there be an instance where, say, the Bank of Canada will move at a different speed than the Federal Reserve? Let's say we're in that situation where the Bank of Canada will need to raise interest rates and the Federal Reserve will kind of remain on hold, and I won't get into the reasons as to why that could happen. That's an environment where the Canadian dollar potentially could rally. And again, that to me is an environment where you want to consider an instrument like a CDR. For anything that's in the United States. And if we take it outside the United States and we look at the international backdrop, there's several other factors we have to consider for the way the Canadian dollar trades against the euro or the yen, right? And again, there's probably a greater chance the Canadian dollar will rally against those currencies. And exposures in those domiciles, again, makes a lot more sense to be hedged.
How much does, because we hear so much about the tariff war in the headlines and stuff like that, right? That's what really captured investors' attention. How much does your BMO's view on where things could go hinge on what happens in that trade war? There's obviously many factors that weigh into these things. How significant is that one?
Oh, they're incredibly significant. Yeah, especially for when it comes to the Canadian backdrop, and given the fact that we are quite reliant on the United States and trade with the United States as an important domestic driver of our economy. We attribute a substantial degree of risk weighting to what happens with respect to these trade talks and what that means for our economy going forward, and also what it means for the Canadian dollar.
So bottom line, if you were sort of pessimistic about the tariff war vis-a-vis really to Canada, would CDRs be something that might be more appealing or less appealing?
Depends on the market we're talking about. So let's focus a little bit on the international market. So let's say the trade war metastasizes and becomes worse. And remember, we talked about the fact that means that we're shifting away from a free trade backdrop to effectively a backdrop where trade barriers are much higher than they have been before.
Right.
So you have a greater chance of economic divergence between several developed market economies. Let's say between Canada and the United Kingdom, the Eurozone, Japan. They don't really move together like they used to. So if we're moving at different speeds, inherently and empirically, we know from our prior observation, those are the types of regimes where volatility is going to be higher. Right? And again, diversification, in our view, can be a significant dampener of that volatility insofar as the portfolio is concerned. Right? And that volatility, it'll arise because of foreign exchange risks. And again, that's why directly we think that CDRs make sense in that sort of environment.
Okay, well, appreciate you giving us, again, a peer into the crystal ball here and kind of helping us understand how CDRs might be affected by all these international developments, something that investors really need to watch closely, of course, here. But again, thanks again so much for that. I want to, just really highlight to our audience here, if you're enjoying the conversation right now, make sure you check out TD Direct Investing on social media, okay? We're all over it. We're on YouTube, we're on Instagram, we're on Facebook. And there's so many insights that you can get from guests like Bipan here and the many others that we speak to on a weekly basis here. So you can scan the QR codes on screen here. That'll take you over to those various platforms. You can get a sneak peek at upcoming episodes and a ton of other content designed to help build your investing knowledge. Another thing I want to remind our audience too, if you have a question about CDRs, we want to hear them. So our live Q&A segment is coming up in just a moment here. So if you're watching on Webbroker, you can use that chat box to send the questions to us. Again, if you're on our broadcast platform, use the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your questions. All right, Bipan, we had teased a little bit earlier here some ticker trivia fun that we're going to have here with Brian Rogers here. Brian, we're going to welcome you back here and get you involved in on this. I'm going to quiz you guys on your CDR edition ticker trivia here, okay? Now this is tough, guys, all right? Now, I didn't pull any punches here on the ones that I picked here. So, you know, just be good sports about it, see how much you can get right here. What's gonna happen is I'm gonna read you each a series of CDR ticker symbols, and you're gonna tell me the company it represents, and whichever one of you guys gets the higher score wins the game. You get bragging rights and stuff like that. And Brian, I wanna start with you, okay? Are you ready to go here? Have you been boning up on your CDR ticker symbols here before this episode?
A little bit, Rob. I gotta admit, I get excited if I'm on Jeopardy and this category comes up on ticker symbols, but I'm not sure on the international ones. We'll see.
I saw you when you were doing the demo there for us. I saw you were hanging on that screen a little bit of a long time there at moments. I was wondering if you're trying to quickly study, before we get to this trivia here. But in any case, let's see how many that you can get right here. So without further ado, which companies do these ticker symbols represent, Brian? Okay, the first one is ADI.
That would be Adidas.
Okay, HNDA.
Well, that one I used to have an old Honda Civic.
Aha.
It's got to be Honda.
All right, MTSU.
That one, I just saw it today, Mitsubishi.
Nice. Okay, NEST.
This one, I think I know what that is. Huge company. I think it's one of the biggest companies in the world, Nestle.
Okay, and
Food
the last
companies,
one,
anyway.
the last one, NOVN.
That was the one I just showed, so Nova Nordisk.
Brian Rogers coming in with some heat and thunder here. Look at that. Let's reveal the answers here for our audience here. Brian, a perfect score across all of them. You nailed Adidas, you nailed Honda, you nailed Mitsubishi, Nestle, Novartis. Wow, I'm impressed, man. I don't know if I could have pulled that off. And Bipan, now you got some pressure on you, man. This is
a lot of pressure, yeah.
Okay, let's cue up our board here, yeah. So which companies do these ticker symbols represent? Okay, CANO.
Oh my goodness. CANO. Good Lord. What would that? You got me.
Take a guess.
I'm not sure I know, to be honest with you.
Wow, okay.
No.
All right, Brian, you've claimed an early victory here, but now we got bragging rights here.
Man.
Okay, HTCI.
I'm going to say
Hitachi, you got it. Nice.
Yeah.
That's a hard one.
That's a hard one, yeah.
MB.
Oh my God, I feel like all of mine are much more difficult than Brian's. MB.
I'll give you a hint. Vroom, vroom.
Oh. Vroom, vroom. It's not BMW, is it?
Close.
Oh,
Mercedes-Benz.
Mercedes-Benz, of course, yes.
NTDO.
Oh, that's easy. It's the one I just referenced. That's
right.
Nintendo.
You got it. And the last one, NVON.
My initial instinct would be that's Novo Nordisk.
Wow, that one's
Yeah.
good. You know what one stumped you here?
It was
CANO. Let's see the answers here, just for our audience's sake here. CANO. That was Canon. Canon. Probably not a company. A big company still.
It's a big
probably,
company.
Probably
there's
not
no
one that
excuse.
people are really top of mind here.
I should have known
You
that.
got Hitachi, Mercedes-Benz, Nintendo, Novo Nordisk. Hey, listen, it looked like you might have been in trouble early on, but you brought it back, man. 4 out of 5. Like, that's really good. So,
I mean, the Mercedes-Benz one is embarrassing, so I'll chalk that up to me just being having straight.
Yeah, Brian. To your point, maybe it's my TD bias here. I did give you a little bit of the easier ones here. So, anyway, I appreciate you guys both being good sports about it. Really great stuff here, and it's not easy to do. So, appreciate both of you guys. Brian, we're gonna let you go for now, but we'll see you next time. Appreciate you joining in.
Oh, thanks so much. It was fun, guys.
All right, good stuff, guys. Now, without further ado, let's get to our live viewer Q&A. Do you want to hear what our viewers want to know more about?
Sure. Yeah, absolutely.
All right, let's call up that first question here, see what we got on tap. We got a question from Rodney, and Rodney wants to know, do CDR holders have voting rights at the AGM?
They do. Right, so it's very much like owning the actual share itself. So that comes with all the same benefits that you would get from owning the shares directly.
And like, how does that work in terms of getting like the paperwork sent to you and all that stuff?
Right. So we do have information on that via our website, and anybody that's interested in that information, we would encourage to read up there.
Mm-hmm. Okay. Yep. So, but it is again, I imagine it's probably a similar type kind of process. Yeah. Okay. Okay. Good to know.
It's exactly like owning the underlying share. The only difference is that again, it trades in Canadian dollars on Canadian exchange.
Right. Yep. Next question we have here is coming to us from John. So let's see what John wants to know about. John is saying, I can see the advantage of CDRs for small dollar portfolios. Mm-hmm. What break-even point in dollars would you recommend for choosing CDRs over holding foreign securities directly?
Very good question. And this isn't a cop-out, but to me, that's a question that would depend on the foreign security that we're talking about, right? But again, in my mind, the one thing to remember is that if you are constructive on a particular company, and if you like that diversification risk, then the CDR offers that accessibility, right? So again, Canadian dollars trades on in terms of Canadian dollars on Canadian exchanges, also in terms of fractional shares as well, right? So that's something else to take into consideration for any break-even analysis that anyone's doing.
Right. I mean, the other thing too you mentioned is that some of these, the accessibility of some of these foreign stocks may not be available to you depending on what brokerage you're using, right?
Yeah,
like not
exactly.
everybody has it. So
exactly. Yeah.
Another reason to keep CDRs in mind.
Yep.
Okay, let's see what we got next on tap here for us. Martin's got a question for us. Martin says, are there withholding taxes on dividends or at the time of sale when you're using a CDR?
So there are withholding taxes applicable on dividends, just like there would be with any foreign share.
Mm-hmm. Okay. So that and that's again, you were mentioning that sort of changes depending on what country rather we're talking about here.
Right.
I mean, not to put you on the spot, but I think a lot of people are familiar with the U.S. Withholding tax regime. Maybe you can just clarify that for us. And are there any other major ones that are top of mind for you that you can recall?
I mean, I would say the U.S. one is the easiest one, just because there is a treaty with the United States that allows the withholding tax to be reduced from 30% to 15%. But again, that information is available on our website insofar as Canada's agreements with other countries like Germany or Japan or Switzerland and Denmark. But effectively, the process is very similar, right? So there is a withholding tax applied to dividends that Canadians can bring down based on the paperwork and of course the applicable tax treaty rate.
Mm-hmm. Okay, good to know. Yeah, I mean, I know it's putting you on the spot there, so that'd be pretty. If you could remember that.
I've got a lot of things on my mind. I mean, tax treaties between the different countries is something that I'm afraid we have that information available on the website. I just don't have it on hand.
Yeah, no, good, and good call out for people to check that out if they're interested. Let's take our next question here. This is coming to us from a viewer on WebBroker. They're saying, are there any advantages or disadvantages to holding CDRs compared to just regular stock shares?
Yeah, absolutely. I mean, I think we've touched on this a few times, and I think it's important to go over it again. The advantage of having a CDR, firstly, accessibility. Right. So again, oftentimes a lot of domestic brokerages won't be able to access foreign markets, and so if you're particularly bulled up on a stock that trades in Japan or Germany, CDR allows you to participate. Also, it does so at a reasonable price and a more accessible price because it does trade at a fraction of the notional amount that's traded on the exchange in say Germany or Japan. And of course, the third element to this, and I think this is a powerful driver, is the fact that it obviates your FX risk by a significant degree. Now, that's why it's different from the ADR. The ADR does not do that. The CDR does allow you to mitigate your foreign exchange risks, right? So, that can work to your benefit, especially in cases where the Canadian dollar appreciates, which is disadvantageous if you have the underlying share on an unhedged basis. Oftentimes, there might be instances where the Canadian dollar weakens and you hold a CDR and it doesn't look as beneficial from that limelight. But we would say that over the longer term, and I've said this a few times, but again, worth going over again, FX risk on a longer term basis is usually not rewarded. much like other risks that investors take.
Right. Okay. Richard has a question for us. I know. I want to get to as many as we can here. Richard is asking, would you recommend holding CDRs in a RIF portfolio or other registered plans?
That is dependent on each investor and their preference. I mean, that's not something that somebody like me can unequivocally say would work for everybody, right? So I would encourage people to do their own research, talk to their financial advisors and see what makes sense to them. But as an investable tool, CDRs offer a tremendous amount of benefits for anybody looking in the international marketplace.
Yeah, and I mean, of course, like, you know, one of the top of mind things I can think of even is just like, you know, TFSA might make sense if you think you might need that money sooner than retirement.
Right.
And, you know, your RIF or RSP, what have you.
Right.
If it's more of a retirement saving, really long-term type kind of thing. So maybe something to keep in mind there.
Absolutely.
Okay, let's see what else we got on tap here. What's coming up next here? Sandy has a question for us. Sandy's saying, what happens when BMO stops sponsoring a particular CDR? Yeah, it could be BMO, could be any of the issuers of it. Like, yeah, what happens in that case?
It's a good question. Again, I'm going to direct the viewer to our website in that sort of instance. And if they do have a particular question, feel free to ask us. But off the top of my mind, that's not something I would position to answer right now.
Yeah, do you think, would it be at all similar when that happens with ETFs or anything like that? Like a fund closes down or something like that?
Yeah, I would imagine the treatment is very similar. But again, I would direct everyone to the educational content.
For sure.
Yeah.
Okay, we got a next one coming up here for us. Let's check it out. Jacqueline wants to know, does BMO offer ETFs that bundle CDRs by industry or country?
At this point, no. It's an interesting idea, an interesting concept, but something that we don't offer right now.
Yeah, and I don't think anything like that even exists in the market.
I don't think so. No, CDRs are a very nascent market on their own, but that doesn't mean the space can't evolve over the coming years.
Do you think, just on that point, with CDRs being like a relatively new product, like writ large here, what might somebody want to keep in mind when they're researching, past performance and considering, the risk level that they might present? Like, can you just look back on whatever the underlying is, and that will give you essentially the information you would need to know, or is there something unique about CDRs in that sense that you might want to consider as well?
I mean, if we're looking at CDRs, understanding the fundamentals of a particular company are going to be extremely important, and also understanding the foreign exchange risks, because again, they are embedded in the decision on whether or not you're going to invest in a CDR or try to invest in the shares on an unhedged basis. Both of those are going to be important inputs. Now, being a foreign exchange strategist, I can unequivocally say that understanding the fundamentals of a company are going to be much, much, much more easier than trying to project over the 4-month basis which way the currency is going to move.
Sure.
Right. So what we're doing with the CDR is we're saying focus on the company, do your homework and research on that from that perspective. The foreign exchange element of it, we've taken care of for you via the notional hedge.
Yeah, and currencies can be notoriously difficult to trade around.
Yeah. I get asked all the time, dollar Canada, where's it going to be in 3 to 4 quarters time from now? And I liken it to projecting what the temperature is going to be in December. We know it's going to be cold, but I can't tell you if it's going to be 0 or -10. Right, that can mean a world of a difference to an investor.
Yeah, give me the lottery numbers while you're at it too. Might as well. We got another question coming into us here. Let's check out what we got here. Shetkan Kumar, I hope I got that right. If you hold foreign equity through CDRs, is the distribution considered foreign income? And if so, is the holding also considered a foreign asset?
So the income will be taxed as if it's a foreign income, right? It is not considered a foreign asset per se because it trades in Canadian dollars on Canadian exchanges.
Right. Okay.
Yeah.
Yasmin's got a question for us here, and I believe this is the last one that we have time for here. Thank you for all the fast and furious answers you've been giving us here, Bipan. Lots of interest in this. Please clarify, Yasmin wants to know, are CDRs used for international stocks excluding U.S. stocks, and do you need to buy an ADR for U.S. stocks?
No, there are CDRs available for certain U.S. stocks, and certainly we at BMO Asset Management are looking to expand into the United States as well, right? So you don't need to buy ADRs strictly for U.S. stocks would be my answer to that.
Okay, wonderful. I think that's all we had time for, but that was fast and furious, and we threw a lot at you, and like a consummate pro that you are, you tackled them all. So, Bipan, really appreciate you coming in, answering the viewer questions, and just giving us a lay of the land on CDRs. Really appreciate it.
My pleasure, Rob. Thank you for having me.
And of course, for you in the audience, thank you so much for asking all those fantastic questions and for tuning in as always. If you want to check in on next week's episode, we got a good one for you, especially with back to school season in full swing here. We're going to talk about top RESP tips here, your registered education savings plan. That's another mouthful right there. A lot of people are wondering, what's the best way to get money in? What's the best way to get money out? our guest speaker is going to share that perspective with us next week. So make sure you tune in. Maybe it'll give you some ideas for your own child's education savings. That's all the time we have for today, though. From everyone at Inside Investing, thanks again for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.